Hello, my name is Fajar Dewanga Alamzaya from the Indonesian Technocrat University, Faculty of Economics and Business, Accounting Study Program. Here I will explain the meaning of accounts, the 5 types of accounts, the normal balance for each account, and how to enter transaction into the general journal. Accounts are an accounting medium for recording financial transactions that result in changes in assets, debt, capital, income and expenses. In this recording, accounts will be classified based on similar transactions. In the end, the recording and classification of these accounts will be used as a basis for preparing financial reports. In the world of accounting, account classification is carried out to fulfill 3 main objectives, namely, shows the location for recording elements of assets, liabilities, capital, income, expenses, and private. Shows the growth or reduction of the elements of assets, debt, capital, income, expenses, and private. Become a source of information regarding the position of assets, debts, capital, and changes. This will be used as the basis for preparing the company's financial reports. In accounting, account classification is generally divided into 2 types, namely real accounts and nominal accounts. A real account, fixed. Real accounts are a group of accounts that are reported in the balance sheet. These types of balances are assets, liabilities, and capital. In its application, real accounts will be carried over from one period to the next. B. Nominal account, temporary. Nominal accounts are a group of accounts presented in the income statement. The types of these accounts are income and expenses. Based on the 2 general classifications above, accounts can also be classified in more detail, namely consisting of asset accounts, liability accounts, capital accounts, income accounts, and expense accounts. 1. Assets, treasures. Assets are asset accounts owned by a company that can be converted into cash. For companies, assets are a source of wealth to run the company. This asset account includes costs incurred due to previous transactions and as future benefits. These assets are classified into 5 types, namely, current assets, which are company assets in the form of cash and bank account balances that can be withdrawn. Things that are classified as current assets are cash, securities, notes receivable, trade receivables, merchandise inventory, prepaid expenses, and equipment. Long-term investment, namely a form of investment in assets to support the company's main operational activities and not interfere with the company's normal activities. Things that include long-term investments are shares, bonds and funds to pay off long-term debt. Fixed assets, namely tangible assets used in the company's normal activities with benefits of more than 1 year. These fixed assets are also not for sale as merchandise and have a high value. Intangible assets, which means assets that are not in physical form but are in the form of special rights. Examples of intangible assets are goodwill, patents, copyrights, trademarks, and others. Other assets, namely company assets that cannot be classified into the 4 assets above. Examples of other assets are machines, pre-operating costs, and share issuance costs. Assets are grouped into the 5 things above, but you also need to know that not all companies have all 5. 2. Liability accounts. Edit. Liabilities are all economic obligations that a company has in the future in the form of delivery of assets or services as a result of business activities that have been carried out. In simple terms, this obligation is the company's debt. The liability account itself is divided into 2, namely current debt and long-term debt. Current debt, namely obligations that must be repaid in less than 1 year. Matters related to current debt include notes payable, trade payables, unpaid expenses and unearned income. Long-term debt, namely obligations that must be paid but the repayment period is more than 1 year. Things that include long-term debt include bank debt, mortgage debt, bank loans secured by fixed assets, and bond debt, debt due to the issuance and sale of securities. Apart from these 2 things, there are actually other debts that are classified as liability accounts. Other debts include company debt to directors and debt to shareholders. 3. Capital account. Capital is the difference between assets and liabilities. capital is a source of wealth apart from loans which also come from the owner. Therefore, the owner has the right to the company's assets so that the capital account will be accompanied by the name of the owner, while capital accounting in a partnership will be accompanied by the name of the partner. 4. Income account. Revenue is the result of company business activities such as sales of goods or services, rental of assets, and other business activities. This income will of course increase the number of assets and reduce liabilities. 5. Expense account. Expenses are sacrifices during carrying out business activities in order to obtain income. To enter transactions into the general journal, follow these steps. Transaction identification. Determine the transaction that occurred and identify the accounts involved. For example, purchasing goods, selling, or paying debts. Define debit and credit accounts. Every transaction will affect at least 2 accounts. Determine which accounts will be debited and which will be credited. The basic principle of accounting is that debits must equal credits. Record date. Write the transaction date in the appropriate column. Transaction description. Provide a brief description of the transaction to provide context. Enter amount. Write the appropriate amount in the debit column for debited accounts and in the credit column for credited accounts. Mark the journal. After recording, make sure to check and mark the journal so that the transaction is recorded correctly. Example, if you buy goods for IDR 1 million in cash. Date, October 1st, 2024. Debit account, inventory, 1 million Indonesian rupiah. Credit account, cash, 1 million Indonesian rupiah. Description, purchase of goods. The general journal will look like this. Date description debit credit. January 10th, 2024 inventory IDR 1 million. Cash IDR 1 million. Purchase of goods. After these steps are completed, make sure to prepare financial reports periodically based on the general journal that has been created.